Hello everyone, and welcome back to Boss Economic World, the show where we slice through the financial jargon like a hot knife through a very expensive block of Swiss cheese. Today's date is November 15th, 2025. And folks, what a day. The White House is popping the champagne, probably not French, mind you, because they've just announced a deal with Switzerland. On the surface, it looks like a classic win-win. U.S. Trade Representative Jameson Greer, looking very pleased with himself on CNBC this morning, announced that the punishing 39% tariff slapped on Swiss goods back in August is being rolled back to a much more manageable 15%. In exchange, Switzerland has apparently opened its national wallet and committed to a staggering $200 billion in investments into the good old US of A over President Trump's term. They're also promising to buy a few more shiny Boeing jets. So, the crippling trade war that nobody really asked for is over. Swiss watchmakers can breathe a sigh of relief, American manufacturers are supposedly getting a flood of cash, and everyone can go back to enjoying their fondue and freedom fries in peace. A beautiful story, right? Wrong. Because if you think this was a story about free trade, you've missed the entire plot. This wasn't a negotiation. This was a shakedown. This wasn't a trade deal, it was the geopolitical equivalent of a mobster walking into a fine watch shop, smashing the glass display case, and then offering to sell the owner protection from himself. To understand what really happened, we need to peel back the layers of this story. And trust me, it's like a Swiss onion, lots of layers, and by the end, you'll probably be crying. Let's connect the dots. Rewind the clock just a few months to August 2025. The global economy was chugging along, doing its thing. Then, out of the blue, the Trump administration stunned the world, and especially the very surprised government in Bern, by imposing a massive 39% tariff on virtually all Swiss imports. Now, let's put that number in perspective. 39%. At the height of the trade war with China, the average U.S. tariff on Chinese goods peaked at around 21%. The tariffs on EU steel and aluminum that caused so much drama were 25% and 10%. This new tariff on Switzerland, a stable, wealthy, Western democracy and a historic ally, was nearly double the rate applied to America's biggest geopolitical rival. It was economically insane. The official justification? The White House pointed to a supposed $40 billion goods trade deficit with Switzerland. Now, I know what you're thinking. Boss, a $40 billion deficit sounds like a lot for a country the size of West Virginia. And you're right, it does. But this is where the magic trick happens. This is where politicians use a big, scary number to justify an action, knowing that 99% of people will never look at what's inside the number. But we here at Boss Economic World? We are the 1%. So, let's pop the hood on that $40 billion figure. What does the US actually import from Switzerland? Is it an endless flotilla of Toblerone bars and cuckoo clocks? Not quite. The two biggest categories of US imports from Switzerland are pharmaceuticals and gold. And this is the key to the whole illusion. First, let's talk pharma. Switzerland is home to giants like Novartis and Roche. But here's how the modern pharma supply chain works, and it's a masterclass in tax optimization. A US-based research team, maybe funded by Novartis, discovers a new drug. The intellectual property for that drug is then legally domiciled with the parent company in Switzerland. The drug itself might be manufactured for pennies on the dollar in a low-cost country like Ireland or Singapore. Then, the finished product is sold from the Irish subsidiary to the Swiss parent, and then imported into the United States by the American subsidiary at a vastly inflated price. Why? It's called transfer pricing. By recording the highest price in a low-tax jurisdiction like Switzerland or Ireland, the company minimizes its U.S. tax bill. So when U.S. Customs sees a shipment of pills arrive from Switzerland valued at $1 billion, it's not because it cost $1 billion to make them. It's an accounting entry designed to move profits around the globe. That $1 billion entry gets chalked up as a U.S. import, blowing up the trade deficit number. In reality, a huge chunk of that value was originally created in the U.S. It's a shell game. And the White House was treating it like Switzerland was physically shipping mountains of gold-plated medicine across the Atlantic. Second, and even more absurd, is the gold. Switzerland isn't a gold mining country. It's the world's laundromat for gold. It's home to 4 of the world's 5 largest gold refineries. Raw gold comes in from mines in Africa, Asia, and Latin America, gets melted down, purified, and stamped into shiny bars, and then gets shipped out to financial centers like London, New York, and Hong Kong. When a U.S. bank or the Federal Reserve needs to balance its books or take physical delivery of gold, it often flows through Switzerland. This isn't trade in the sense of a country selling its national produce. It's a purely financial flow. Treating a $1 billion gold shipment is the same thing as $1 billion worth of imported cars or textiles is economic malpractice. It's like counting your ATM withdrawals as a trade deficit with your bank. So, when you strip out the accounting fiction of pharma and the financial flows of gold, that scary $40 billion deficit shrinks dramatically, to maybe $5 to $10 billion in actual, tangible goods like watches, precision machinery, and cheese. A deficit that's small with a country of 8.7 million people is, frankly, a rounding error in the $27 trillion US economy. The $40 billion deficit wasn't a reason for a trade war. It was the excuse. So, if the deficit was a phantom, what was the real goal? Simple: leverage. The Trump administration effectively took the entire Swiss export economy hostage. The 39% tariff was devastating. Think about it. For a company like Swatch Group or Richemont, which sells luxury watches, a 39% tariff is a death sentence in their most important market. A $10,000 Patek Philippe suddenly costs $13,900 before the retailer even adds their markup. Sales would plummet. The Swiss machinery industry, which competes with German and Japanese rivals on razor-thin margins, was instantly priced out of the market. The tariff was an existential threat. So, Swiss officials and business leaders did exactly what the White House expected them to do. They panicked. 4 months, they engaged in shuttle diplomacy. That's a polite term for frantically flying back and forth to Washington to beg for mercy. They weren't negotiating from a position of strength. They were negotiating with a gun to their head. The US wasn't saying, let's find a mutually beneficial outcome. The US was saying, nice export economy you've got there. Be ashamed if something happened to it. Now, what are you prepared to do for me? And that brings us to today's deal. The centerpiece of this agreement is the $200 billion investment pledge. It's a massive, headline-grabbing number. And it's almost entirely smoke and mirrors. Let's do some more math, shall we? Switzerland is already one of the largest foreign direct investors in the United States. In fact, for the last several years, Swiss companies have consistently ranked as either the number 1 or number 2 source of new foreign investment into the US. According to the latest comprehensive data from 2023, the total stock of Swiss FDI in the US was over $700 billion. In 2024 alone, Swiss firms invested about $65 billion. Now look at the deal. A promise of $200 billion over the remainder of President Trump's term. That works out to about $67 billion per year. Do you see it? They've essentially promised to keep doing what they were already doing. Swiss pharmaceutical companies like Roche and Novartis have massive R&D and manufacturing footprints in the US. They were always going to invest billions next year to upgrade facilities in New Jersey and California. Swiss food giant Nestlé was always going to expand its US operations. This deal is just taking all the pre-existing, non-negotiable, multi-year investment plans of every major Swiss company, gift-wrapping them, and presenting them to the White House as a new concession. It's brilliant political theater. The Swiss government gets to save its industries from the tariff guillotine. The White House gets to hold a press conference and announce, we stood up to the Swiss, and they folded. They are sending us $200 billion and bringing jobs back to America. And what about the specific industries mentioned? Pharmaceuticals, well, we just covered that. That's business as usual. Railway equipment? This is a clever nod to the Rust Belt. The biggest Swiss rail company, Stadler, already has a manufacturing plant in Salt Lake City to comply with Buy American provisions. This commitment likely means they'll promise to bid on a few more contracts for Amtrak or City Light Rail systems, something they would have done anyway. But my favorite part is the promise of investment in gold smelting. Gold smelting in the United States? With US labor costs and environmental regulations? As we discussed, Switzerland's role is as a hub. The US is a destination, not a processing center. The idea of building a major gold refinery in, say, Ohio, is economically nonsensical. This is a throwaway line. It sounds good, it sounds industrial, it sounds like real work. It's pure fluff, designed to be part of the press release and then quietly forgotten. So, who really wins and loses here? Winner number 1, the White House. They get a massive political victory. They created a crisis, solved it on their own terms, and have a giant number, $200 billion, to campaign on. They can claim they are reshoring manufacturing and holding allies accountable. It plays perfectly to the base. Winner number 2, Boeing. Tucked into the deal is a commitment for Switzerland to buy more Boeing planes. This is a classic deal sweetener, directly rewarding a major American industrial champion and its vast web of suppliers across the country. The ambiguous middle, Swiss corporations. On one hand, their stocks will soar tomorrow. Swatch and Richemont are saved. Novartis and Roche can continue their global tax strategy. On the other hand, they were just publicly strong-armed. They had to package their normal business plans as a political concession, setting a dangerous precedent. Their CEOs are smiling for the cameras, but fuming in the boardroom. Loser number 1, the American consumer and the Swiss economy. A 15% tariff is better than 39%, but it's not 0%. Before this whole charade, the average US tariff on Swiss goods was around 1 to 2%. So, we've gone from 2% to 39% and back down to 15%. Don't expect your next Swiss watch to get cheaper, that 15% tariff will be baked into the price. This deal effectively locks in a new, permanent tax on goods from a friendly nation. Loser number 2, the idea of rules-based global trade. This is the biggest casualty. This entire episode sends a clear message to every other mid-sized US ally: the rules don't matter. Your long-standing relationship doesn't matter. If the US administration needs a political win, it can invent a problem, threaten your economic lifeblood, and force you to pay a tribute in the form of investment pledges and high-profile purchases. Who's next? Singapore? South Korea? Japan? The playbook is now written. So let's put it all together. This wasn't a story about a trade deficit. It was a story about power. The Trump administration used a statistically misleading number as a pretext to create a crisis. They targeted a wealthy, isolated ally that couldn't fight back effectively. This forced the target to the table, not to negotiate, but to capitulate. The final deal is little more than a repackaging of pre-existing investment flows, plus a few politically useful trinkets like Boeing planes and a fantasy about gold-smelting plants. The US tariff doesn't even return to its original level but settles at a new, higher baseline of 15%, which will be paid for by businesses and consumers. The result? The administration gets a spectacular PR victory, claiming it has bent another country to its will and secured a historic investment. The Swiss get to escape the economic abyss they were pushed into, at the cost of their dignity and by making promises they were going to keep anyway. It's a masterclass in transactional, strong-arm politics. It has very little to do with sound economics, but everything to do with winning the news cycle. And it fundamentally changes the game for America's allies, who now know that the price of friendship can be renegotiated at any time, with a tariff gun pointed at their head. That, my friends, is the full picture. It's not as pretty as the White House press release, but it's a lot closer to the truth. Thanks for tuning in. Stay sharp, question the numbers, and always look for who's paying the bill. I'll see you next time on Boss Economic World.